Now to a dramatic move by the Federal Reserve to try to stop the surge in inflation that's affecting every American family. Stocks jumped yesterday in response to the biggest hike in interest rates in nearly 30 years, 3/4 of a percentage point. Carter Evans is following all of this from Los Angeles. Carter, good morning.
Good morning, Michelle. The interest rate that we're talking about here, it's called the federal funds rate. Now, this is what the government charges banks to borrow money. Loan rates for consumers are going to be even more expensive because, of course, those banks need to make money themselves. The idea is that if you make that money more expensive to borrow, people won't spend as much, hopefully bringing prices back down to earth.
We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so.
The last time the Fed raised rates this dramatically was in 1994, when inflation was only at 2.7%. Last month, it surged to 8.6%. Despite the bold action, the central bank can only do so much.
I think that events of the last few months have raised the degree of difficulty. There's a much bigger chance now that it'll depend on factors that we don't control.
Like a war in Ukraine and a pandemic that roiled the economy.
I had 2 jobs and money was great, but thanks a lot, COVID-19, you killed that.
This 47-year-old single mother in Pasadena, California, now relies on a food bank. Is it hard to make ends meet?
Yes, it is.
And she's considering leaving the state to escape the skyrocketing cost of living.
I love the state of California, don't get me wrong. But the tides have turned, like, we have to migrate.
So far, interest rates are up 1.5% this year. That means a loan for the average new car price of $47,000 will cost almost $60 a month more in interest than last year. And more expensive loans could discourage spending, which will reduce the insatiable demand now driving inflation to 40-year highs.
All these loans are going to get more and more expensive.
CBS News analyst Jill Schlesinger says it's time for Americans to start saving and paying off debt.
The best thing you can do is try to pay down those kinds of rates that adjust when interest rates adjust. If the economy were to slow down, if a recession were to occur, it's always good to have those emergency reserve funds beefed up.
And think about this. Borrowing is just going to keep getting more expensive. This is not the end of the rate hikes. Next month, expect another 0.5 to 3/4 point increase. And by the end of the year, the central bank right now is predicting that the Fed funds rate could be as high as 3.4%. That's a lot higher than it is right now. Tony?
Wow, Carter. And Fed Chairman Jerome Powell is saying he does not want to induce a recession. He's trying to be clear about that. But these moves could bring one on.